what we want to discuss with you today, so is obviously to present the economics of mutuality. So we'll tell you more about that, but it's obviously based on this principle of mutuality, and also to talk about finance for prosperities. So initially it was called finance for impact, but then we felt that prosperities is probably a better word because, well, and we have plural because it can be human prosperity, social prosperity, environmental prosperity, and so on, financial prosperity. So you can actually, you know, use prosperity to also reflect what we call the 4 forms of capital, which I just mentioned. And we also felt finance for impact may be a little bit misleading because, you know, you have the impact investing theme, and so it can create a bit of a confusion, hence the title. So maybe if we go to the agenda. So what we should be talking about today, and hopefully it will appear on the screen, but we will start with a 10 minutes presentation on the Spirit of Geneva. We will, which Bruno will walk us through. We will then talk about EOM and its history and what EOM stands for. So EOM, by the way, is Economics of Mutuality. So we'll be using the word EOM, just that you know. Then we'll have a panel to discuss the topic of today, so deep dive into the topic of today. We'll have a short break, 5 minutes, and then we'll actually talk about the role of economics of mutuality in finance for prosperities through private equity, because we've started working with PE players and we would like to explain a little bit how we believe the approach is highly relevant for the PE space. Before I hand over to Bruno, I just want to maybe introduce myself. I haven't had a chance to do so. So my name is Nadia Terfous. I'm actually leading Economics of Mutuality Solutions, which is the management's consultancy, which helps organizations become more mutual by putting purpose into practice. And I joined a 1.5 years ago, so when EOM became independent from Mars, where it was born, so Mars being the US privately owned company, which you may know, which is active in pet care, food and confectionery. And I come from McKinsey & Company, where I was a partner before in the Geneva office. So I'll hand over to Bruno. Maybe let me introduce Bruno Roche. So Bruno is actually the founder and executive director of the Economics of Mutuality platform. He was a chief economist with Mars and actually spent almost 30 years with Mars. He was also leading the think tank of Mars called Catalyst, which actually gave birth to the Economics of Mutuality. And yeah, and I think we are also here today thanks to Bruno, so who chose also Geneva as the center for the Economics of Mutuality.
Thank you, Nadia. Good morning, everyone. Good morning. Is that okay if I stand next to the podium, right? Thank you. Well, thank you very much for all of you who have come. I mean, I feel like a professor actually who's starting the course at very early in the morning, and you have just a few students around. So congratulations to you all. And well, for the one who didn't have a chance to come, we forgive you. All right, it's okay. It's early, it's cold, and it's the middle almost of the night. So yeah, so I just would like to spend a few minutes here to talk about what is called the Spirit of Geneva. You know, I moved to Geneva about 1.5 years ago, and Geneva has always been a special place for me and my family. I come from a place in southern France, which actually is the cradle of the Huguenot movement. So it's been actually Geneva always had a special place in my heart. But when I moved to Geneva, actually, I discovered a concept called the Spirit of Geneva, and I was very intrigued by this expression. I knew it's a wine here, but it's also something much more than a wine. And because you don't speak about the spirit of Brussels or the spirit of London, so I was intrigued by this concept of Spirit of Geneva. And I discovered actually it's something that is goes back into the roots of the city and the sitting century with Calvin and eventually with Jean-Jacques Rousseau and Dunant. And I sense actually that's why it's critically important to go back in history and to understand actually why this city, Geneva, potentially be the place where the reformation for finance could take place. And I'd like to just start with this provocation. When the Spirit of Geneva is called to challenge the city of John Calvin and reform finance to put it at the service of the common prosperity. So what is the Spirit of Geneva? Spirit of Geneva is an expression that actually is very well known among the Genevians, but it's also a book. It's a book that was written in 1929 by a French Huguenot, actually a French Protestant called Robert de Tras, sorry. And actually he lived in the old city. He married Valentine Pictet, and actually was very instrumental in understanding that spirit. And that spirit actually is at the confluence of, in a sense, three characters that actually have characterized the city of Geneva. The first one is Calvin, actually, who brought the concept of reformation and also this idea of emancipation at a time when eventually we were at the end of the Middle Ages and beginning of the Enlightenment. There is a few centuries later, there was this opening, the openness, this thinking of the openness, like of Jean-Jacques Rousseau, actually, who was the author of the social contract, and eventually Henri Dunant, who personified through the setup of the Red Cross the compassion for all the miseries of the world. So essentially, you could argue that the Spirit of Geneva exists when you have the combination of the rigor of Calvin, the openness of Rousseau, and the compassion of Dunant. And when these three characteristics are together, then the Spirit of Geneva can start overflowing over the world. And this concept of overflowing is a beautiful expression that Robert de Tras is using. So it's very nice because it's not about conquering, it's not about taking over, it's about overflowing. So there is an element of generosity also in this expression. So let's start with three times in history when eventually the Spirit of Geneva has overflown. The first one is essentially the Reformation of 1536. And I like this idea of concept of the turnaround from above, which is actually an expression from the theologian Olivier Facio. And to recover the power of criticism with regard to the human inventions opposed to ethics. I repeat the expression. It's not from me, actually. It's from Olivier Facio, who said the power of criticism with regard to the human inventions opposed to ethics. So at some stage, finance is a human invention, right? And it could be actually in favor of ethics or opposed to ethics. So Reformation is all about the recovery of the power of criticism. The second element is the second. I picked a few actually examples. The one is the set of the Red Cross, which actually has become over the years a pillar of humanism in action. And the word in action is important. And the first one is also the setup of the League of Nations. And Robert de Tras has been actually instrumental. He had set up a society called the Geneva Society with friends, and he and his friend were instrumental when the League of Nations was set up here in Geneva. It was through a series of conversations with President Wilson that eventually Geneva has been chosen as a city to become the city of the League of Nations. And at that time, the debate was between Brussels or Geneva. So actually, through this conversation, which I could go back to the Reformation, the Red Cross, the social contract, Geneva has been changed in its destiny. Because without the League of Nations, Geneva would have been just a city of bankers, right? Not the international city that we all know today. So maybe another element, which actually is quite interesting, because Geneva has been also a place for finance, right? And to some extent, you could argue the practice of finance, which is actually another facet of Geneva, had to some extent facilitated international trade, which you could argue is also has created an environment which is conducive to the emergence of certain forms but superior to banking, of universalism. So this different invention that Geneva set up, the Reformation, the Red Cross, the League of Nations, the practice of finance, is actually constitutes elements of what we call the Spirit of Geneva. So here we have a kind of maybe a bold statement, a bit of ambition. So just as the laws of war were reformed in the 19th century to alleviate the suffering of humanity, maybe today the laws of profit have to be rewritten. That's the vision that we have. And there are a few people here in the audience that we had a discussion with, especially the lady who wrote this book, Corinne Chaponnière, who wrote the biography of Henri Dunant, and we had a discussion, and I had a chance to discuss this with Melker, and she said, well, it's very interesting because today, in 2021, we have actually maybe all the elements actually that could make it possible to rewrite the laws of profit. Because the laws of profit today are creating misery around the world. The laws of profit are creating environmental degradation, all right? So the real issue today is not the war. The issue today is the laws of profit. And we have to be pragmatic. The same way Henri Dunant knew actually he could not abolish war, but he could just alleviate the most difficult consequences. We know we can't just go to the spirit of greed, the spirit of the love of money, but we can at least alleviate some of its consequences. That's essentially why Geneva is such an interesting city for the economics of mutuality. And the economics of mutuality started with a question. You know, sometimes the most beautiful journey starts with a question. And at that time, I was just appointed the chief economist of Mars, the company that makes M&Ms and sneakers and stuff like that. But I had a discussion with the chairman of the board and the CEO of the company at the time. And I was involved in this conversation. I say, well, we have a question. What should be the right level of profit? And the question wasn't asked in the context of should we do more profit or should we do less profit? But is there a profit level that would eventually maximize the performance of the business in its ecosystem? So to my surprise, actually, this question could have been answered in a kind of easy way. I could have gone to a bunch of consultants and come up with a benchmark. But I thought actually, of course, it is an economic question because you could argue there is a relationship between profits and performance and profit, but it was also an ethical question. So what are the principles that actually I could apply just to justify that I take a share of profits from the ecosystem in which I operate and from which I depend? It's not a new question, actually. It's a question that you can, it's been answered a number of times. Here I just have one quote from a man who was known for being like a very wise man, King Solomon. It was written 3,000 years ago. A man may give freely and still his wealth will be increased. And another may keep more than his right, but only comes to be in need. So again, here, there is a relationship between prosperity and generosity, between giving and receiving. You see, the market is all about buying and selling. But there is potentially a higher order, which is about giving and receiving. But unfortunately, this question has not been studied in management literature or in economics. You can find some answers in philosophy, in theology, in anthropology, but not in business or in economics. So when I received these questions about 15 years ago from John Mars and his management team, we decided to start this journey, the economics of mutuality. And the reason why it's in mutuality because the underlying principle is that business, and especially financial capitalism, is organized based on the principle of power. Okay? And that's why size matters so much in business. If I'm big, I can actually exert power on the ecosystem in which I operate and we extract value. What we are proposing here is that there is a higher order of value creation. It's called reciprocity. So reciprocal relationship is a higher order for value creation than power relationship. But this had to be organized in the context of management theory and also a series of business cases. And that's actually the journey of the economics of mutuality that now I will hand over to Lucy Keller, who actually has a Swiss passport, but she doesn't speak a word of French. She doesn't speak a word of German. She doesn't speak a word of Italian, right? So I'm glad actually she was raised and grew up in the US, but I'm glad actually she decided to come back to Geneva to be reconnected with the roots of her ancestors. The floor is yours, Lucy.
Dankeschön, Bruno, aber ich spreche ein bisschen Deutsch. I just had to clarify it a little. So after I moved to Geneva, because I figured it's good to keep, you can't master just one language, you know? You have to stay kind of average in several. So, great. So Bruno gave a great introduction to the question of the right level of profit, which was the question which was asked to him in 2006 by the senior leadership of Mars. The origin of mutuality at Mars actually began even earlier than this, with a letter in 1947 that Forrest Mars Sr. wrote to his employees, saying that the purpose of an organization is to give a mutuality of benefits to multiple stakeholders. In this, it was consumers listed first, competitors included, and shareholders last. Now, as a bit of a fun fact, this letter was actually uncovered a few days as it had been lost right before Bruno Roche gave his final presentation on the economics of mutuality to the senior leadership, really showing that mutuality has been present for 60 years before EOM was developed. And this gave a really good environment for the concept of mutuality to be developed, and it was furthered through partnerships with researching and teaching in leading universities, such as Oxford Said Business School. And this has partnerships for different areas of research such as performance management, finance and investing, purpose and small and medium enterprises, as well as public and private partnerships with schools also such as Erasmus, Rotterdam School of Management, Sciences Po, and the China European International Business School. Now, EOM was taken to be an independent platform from Mars in 2020, and it's structured with the overall purpose of completing capitalism and transforming the economic system by creating a mutuality of benefits among all stakeholders. This is done by two parts. The first is a public interest foundation, which has the goal of using academic research, education, and advocacy in order to redefine economic performance. And the foundation has a management consultancy arm which complements this purpose by developing proprietary capabilities, tools, and leadership development with the purpose of enhancing business performance by meeting the needs of the world. For a bit of discussion about who is behind EOM, EOM has a foundation board, which is chaired by Stephen Badger, a member of the Mars family. However, the board is actually a majority coming from outside of Mars. The foundation board is complemented by senior business leaders that are really inspiring, especially in this field, and following EOM for several years, such as Paul Pullman, Martin Radvin, Hubert Joly, and Isabel Kosher. And the EOM management is led by Bruno Roche and Nadia Terfers, who have met, and also complemented by around a team of 20 people at the moment, which is growing, of which half came from Mars, and the other half have joined since EOM has become an independent platform. Now, for a bit of discussion for how EOM works. EOM works by aligning purpose and management behavior for long-lasting holistic value. The transformation of the economic system is done to create a fair and responsible form of capitalism that performs better than the current financial version, meaning you're not sacrificing financial profits, but you're really transforming the system. This is done through methodologies and tools that transform companies at the core, going beyond an after-the-fact or peripheral approach such as CSR or ESG. Three ideas are essential to this. The first is the primacy of purpose, and this entails taking the business, decentering the business from being the center of an ecosystem and putting purpose at the center of an ecosystem, meaning the business is operating around a purpose, not around itself. It also requires that you elevate the concept in business of purpose in business when you are making strategy and business decisions. Now, to do this, there needs to be an orchestration of ecosystems around this purpose. And by putting purpose at the center, you're able to use different external untapped resources. So really taking externalities and using them to solve meaningful challenges in the context of a purpose that a business can set. And this is done because when you take into other stakeholders into account, you can find other resources. Now, through enhancing performance management, you're able to actually incorporate this better into different strategy and management processes. And in order to do this, Mars had researched different types of capital in order to understand how this relates to performance management, and 4 types of capitals were distinguished. Now, these had the added benefits of being stable across time. They also are separate from business itself, meaning that they are able to be also actionable on their own, and they're correlated with financial performance. So the 4 forms of capital are human capital, so health, knowledge, and well-being; social capital, the quality and quantity of relationships in an ecosystem; natural capital, the planetary resources consumed; and shared financial capital, so the typical money, liquidity that you would have. The Economics of Mutuality platform activities also spanned through activities through the foundation and also through solutions. Through the foundation, there's research and education, of which 3 books and over 10 academic publications have come out. And this is through Oxford University, RSM Erasmus, CINSPO, and more to come. So partnership with the Graduate Institute of Geneva and work with the Enterprise for Society. Further, through advocacy, EOM hosts annually the Oxford Economics of Mutuality Forum since 2016 and had 30,000 views in 2020, and it's actually starting today as well. We'll have more information on this later. For the solution side, it has an executive education program focusing on furthering leadership and allowing executives to implement EOM within organizations and really understand how businesses create value through the different types of capital and through mutuality and purpose. This has been running for 4 years in combination with Oxford University, say, Business School. On the side of strategic consulting and tools, putting EOM into practice has been done across industries, including consumer goods, retail, healthcare, and private equity, resulting in over 20 projects in 18 different countries, and IT EOM solutions such as a purpose scanner to measure the quality and quantity of purpose in an organization. Here's a bit of an overview of where EOM has been implemented at the moment. As you can see, it's really spanned both continents and different cultures, showing it's suitable for a variety of contexts and geographies. And I have a brief introduction to the EOM Purpose Scanner tool as well.
From confusion to purpose. From empty talk to bold action. From proving you're good corporate citizens to improving your performance and impact. Measure and mobilize your purpose with the Economics of Mutuality Purpose Scanner.
Great, thank you. And this is Nadia introducing the Finance for Prosperities panel.
Just a couple of words maybe on the Purpose Scanner. The Purpose Scanner is really about measuring and mobilizing purpose within organizations. So we have the typical, I would say, levers of engagement and well-being that you know well, obviously the job conditions, the income, and so on. But you also have, obviously, trust at work, you have inclusion, and we believe you have purpose alignment, and purpose consistency within an organization. So alignment is to what extent the purpose actually resonates within the organization, and consistency is really around to what extent the leaders actually walk the talk and drive impact in society, on society and planet. So maybe just before asking the panelists to join me, we just wanted to give you a little bit of a brief overview of where we are, and it's not perfect because it's actually hard to depict or to give a full picture of where finance is in terms of driving prosperities. But if we look at the investment space, at the global assets under management, we see that today the share of ESG investing it has been rising over the last years and is now reaching about 35% of the global AUM. And if it follows the current trends, in the next 10 years, it could actually reach 100%. But the question is, what does that mean exactly? And it covers very different ESG strategies. So you have I would say the screening and exclusion. So you would screen based on some ESG metrics, on whether the company, the sector, the country is actually, I would say, right. You could also decide to integrate certain ESG factors when making the decision. So you would pick, for example, companies that you consider to be doing well in the ESG space. And you could also really be much more of a driver of change. So by actively engaging with companies, helping them to innovate, to change, to do better, to improve. So that's what we call the stewardship. And then there is obviously the impact investing, which is much more around driving out the right outcomes, for organizations and impact. And maybe I just want to make here a little bit of a distinction, because the question of impact, I mean, it's now a bit of a buzzword, and we don't know exactly what impact means anymore. The way we look at it, we have different ways of thinking of a performance of an organization. So there is I would say, the output, which typically reflects what the organization does. And if I give you an example, a simple example, if you take soap, for example, imagine I take the example of Unilever selling Lifebuoy, which is, a soap for hygiene. Output would be typically, an output measure would be typically the number of units of soap that are sold. The outcome would be to what extent the target population is actually washing their hands with that soap. So that's an outcome matrix. So it's not just what I sell as a company, it's what sort of outcome it drives. And then the impact is typically whether society is better off. So whether we have less infectious diseases, whether we have less respiratory diseases, and so on. So I just want to make that point, because it's really important when we talk about impact. For us, it's really what it changes for society and the planet, not how many units of whatever the company is selling. And maybe just the last thing on impact investing, the question around impact investing is really to what extent it favors impact versus returns, because there's always this thing that potentially impact investing is somehow concedes some returns in favor of impact. While I was talking about active engagement and stewardship, you see that there are more and more activist funds. So funds which actually are shaking organizations, though they have very minority stakes in these organizations. And you see here, I mean, a list of them. I won't go through all of them, but it's interesting. I mean, there are lots, obviously, of energy players that are being shaken at the moment. Just to give an example of Shell, which was actually sued in court for another reason than this one, because the commitments towards carbon emissions were not good enough or were not credible enough. But third point is making is actually trying to propose the idea of splitting the company by because of competing shareholder interests. So they say we should have the legacy assets that are managed differently from the renewables and the LNG assets. Otherwise, it will be difficult for the company to actually evolve and improve and transform itself. I don't know if it's the right way to go, but I think these activist funds, what is interesting is at least they ask questions, they push, maybe sometimes a bit strongly, but and you probably know also the example of engine number one with ExxonMobil, which has basically put in question the strategy, the asset allocation of the company, and has now actually there are 3 new board members that have joined the companies and that have been pushed by engine number one. I just wanted also to mention the fact that there is the investment space, but also if you look at the debt space, we also see an increasing emergence of ESG debt. I mean, it's only at the beginning, but I think it started. So we have now green, sustainable, social bonds. And this year we should reach about $1 trillion. So, I mean, I didn't mention that, but in the investment space is around $100 trillion of assets under management, which is, by the way, also the global GDP, just to keep things in order of magnitude. So, $1 trillion that is, and there was recently the largest individual green bond issued to date in the US by Walmart. And you also have banks now developing loans and ESG-linked bank accounts. So that's that's quite interesting. Now, what are the limits with these trends? So I think the first one, and you know it well, It's what I think Patrick de Cambourg also referred yesterday, and he's not the only one, but to alphabet soup, which is basically the fact that there are, I mean, the data are of poor quality in the ESG space, but you also have a lot of different frameworks, ratings. We have more than 600 different ways of looking at ESG and rating companies. And then there is this big question of what are we measuring? What do we want to measure? Are we looking only at the impact on the company, on the organization, of the risks that the company is taking, or do we also want to see what changes the organization is driving in society and planet, for society and planet? So that's the question of single versus double materiality. The second point around the debt instruments is the same. So basically, we don't have yet a framework that is able to assess very well, I would say, the quality of the issuance. And there's also this question of typically when you launch a bond, a green bond, the use of the proceeds are not necessarily very well followed through. So there's a bit of this question around greenwashing as well. The third point I wanted to make is there is still this question of the fiduciary duties of asset managers. So what should they be actually maximizing on behalf of, and they should have probably a mandate of the asset owners to, potentially, drive more impact. So there's this question of if we want finance to be actually positioned as a force for good or, increase prosperities, there needs to be probably a review of maybe a legal review of what, the fiduciary duties should be, but also the incentive, the compensation policies. And finally, you've seen it, and we've talked about it, the greenwashing and the fake claims. There are more and more NGOs that actually sue companies, but also the SEC, so the US regulator is also investigating into fake claims. It's just a broad question, but there's a bit this question around what will actually move the needle. Will we need regulation? And we know it's coming in Europe, at least. And it's not a question of 0-1, but I think it's to what extent we need regulation versus to what extent we believe in market forces and market-based solutions to actually position finance as a way to improve society and planet. And it's interesting, you may have seen a recent articles by Tariq Franci, who was the ex-CIO of sustainable investing at BlackRock, and who says that basically we are massively greenwashing the ecosystem, the economic system, and that we're only postponing the solution. And he calls basically for regulation, for states to fix the rules. So, without further ado, I would like to ask the panelists to join me. So I'll start with Rosa. So Rosa joined Pictet in 2020 as the head of responsible investing at Pictet Wealth Management. And I guess everyone knows Pictet, so a 200-year-old institution that specializes in wealth management, asset management, alternative investments, and asset servicing. Rosa held various positions before that, including risk manager and portfolio manager in several financial institutions. And she was also advisor and leader in sustainability and impact investment topics at Credit Suisse before joining Pictet, where she also spent 12 years. Thank you, Rosa. Nathan Sismann is the next one. Nathan is a professor of international economics at the Graduate Institute of International and Development Studies in Geneva. He is a director of the Institute Center for Finance and Development, which is funded by the Pictet Foundation for Development. Before that, you held, Nathan, various teaching and research positions in different universities and institutes, and were also a member of the Monetary Committee at the Central Bank of Israel. And you are specialized in finance, financial regulation, financial markets, which are highly relevant topics for today. Thank you, Nathan. And last but not least, Melchior de Muralt. Melchior is the managing partner of the Puri Pictet Turretini, PPT & Co., an investment company that offers wealth management and asset management solutions. You're also the founder of Blue Orchard, an impact investor that actually has had impact that has actually intervened in more than 90 countries and invested about $8 billion to generate positive impact for people and planet. And you're also a member of the committee of the International Committee of the Red Cross. Thank you, Melchior. So my first question is a broad one, to really understand, what finance is. What is the role of finance today? Yes. What is the role of finance today, and so to what extent finance is really moving the needle for people and planet, but also what is the role of finance tomorrow, given what I mentioned also, does finance have the mandate, should finance have the mandate to actually do more? And there is a bit of a question also is at the moment, I feel that we are building, picking impactful companies or building portfolios that choose and pick the right companies. But there's a question also of how do we transform? How do we help companies like the oil and gas sector, but also other sectors, actually transform themselves? So maybe I'll start with Rosa. Rosa, can you tell us a little bit what your thoughts are on that topic, especially in the wealth investment space, which you know well?
Thank you for asking, and Nadia. And I think it's a very broad question. What I feel, and I think that all of us, for example, we have followed the COP26. And after the COP26, a series of, conflicts have come out. In some cases, we have all felt that the world has gone very far. If we look at what was happening, 10 years ago or 5 years ago, we would never have hoped even the result of the COP26. Still, we were not happy with the result of COP26. So there is that element, and then there is the element of finance coming to the forefront. We have all seen what Mark Carney did with the Glasgow Finance Alliance for Net Zero. 450 financial institutions, 130 trillion, at the forefront. And the question is, until now, we have all thought about finance as a service industry. So finance is bridging the gap between people with money and people with ideas. Finance never judged, in general, those ideas. Finance was looking at those ideas, verifying if those ideas were long-term enough, supporting, people that had the money, but not judging. So it was a facilitator. And now we are in this space of looking at finance more as a proactive tool, making decisions in that direction, which is interesting, important moment, but we really need to think about it. Because until now, what has happened is that, as mentioned, as financial operators, we work at the service of our clients. Our clients have some ideas to invest. And what we do is that we analyze those ideas. And we say, okay, this idea is a good one, and it's good for the future. In some cases, look at the, climate, for example, looking at investment ideas that go into the direction of mitigating climate change, it's also something that makes sense from a profitability perspective. Because, if we do not save, or if we don't reduce CO2 emission in the future, we will not go and see Venice. So there is an immediate effect, and immediate meaning, the next 10 years, we are seeing, physical risks, transforming into reality. So there is this, somehow common path. When talking about climate, there is a common path between the impact, if we call it impact, and the profitability. Is it in every topic? Is it in every SDG that we see this, path going together? And if we give finance this role of leading, where is the connection with the profit part? Are we gonna only go through and achieve those topics where we have both the profitability in the medium term, long term, and the solving the issues of the world, and which will be the topic that stay in the back? So that's actually the question that we should ask ourselves regarding what's the role of finance. And that's where I fully agree with the idea that we need to go together, and it's finance and the governments, and governments needs to, and the stakeholders and the consumers and the investors also need to rethink what's the mandate that they give. When people ask me, what can we do for impact? The first thing that you can do is that rethink the mandate that you give, the mandate that you give to your pension fund, but also the mandate that you give when you consume. So these are important things, and we need to think through before giving finance a role without thinking through. In the wealth management space, in particular, we see this because in the wealth management space, we see both sides. On one side, we have clients that completely delegate to us. So for the assets where clients are completely delegating us, we make the decision. So we are fully delegated, and we can decide if we invest in those companies that are decarbonizing or if we invest in the oil industry. If we invest in the oil industry, we are delegated to engage with those companies to vote. There is a part of our assets, and depending on obviously on the bank, you may have a different percentage of your assets distributed. There is a part of our assets where we only advise our clients. So we have continuous conversation with the clients regarding, we think you should invest in that. Do you want to invest in that? So there is a huge part of awareness where we are involved. Awareness, I will not get to the point of talking about education, but it's awareness, very important. So we have a different role there, a role in which we can share with our investors where the world is going and give them our opinion, let them grow. And then there is a part of assets where we only have execution. So we are really only a platform where clients execute. There we have, let's say, less possibility to thrive. Still, we can calculate, we have statistics, we have numbers, in that part. We can put limits, potentially, etc. So it's a complex conversation.
No, thank you. So a lot of education, awareness, and also I understand that when there is a trade-off, it needs to be clear to obviously to the clients, basically, if there is a trade-off between profit and impact.
Absolutely. What I think is that today there is this trade-off. If we look at the risk-return frontier, there are some activities, think about reforestation, is not on the risk-return. So the question is, how do we push those activities that are important for the world to the risk-return frontier? And how do we push? We push it through risk and return, obviously, reducing the risk in some cases or improving the returns. And this can happen, look at the carbon tax. The carbon tax is exactly one of those, tools that we have as society to push, activities on the risk return where we are really interested in it.
Thank you, Rosa. Melchior, do you want to comment on maybe asset management as well as wealth management industry?
Yeah, thank you. No, I think it's a good idea to distinguish wealth management and institutional asset management, because private clients very often have values and tend, like foundations and family offices, to align their values with their investment. And that's one of the main missions of private banking, is to find that subtle balance. But institutional asset manager, insurances, pension funds very often have no other purpose than achieving market rates. And that's why the industry of passive investing develops so much. Trillions of assets are pouring into index fund. I know some pension fund investing even in emerging sub-debt passively, tracking benchmarks, which is striking and could be a danger. What I believe is that with the emergence of more consistent metrics, accounting standards, the passive investing will move progressively towards ESG passive investing. Okay, why not? And that might be a plus. But there will be no way to stop that passive investing momentum. And we in Geneva, we need maybe to be a bit more entrepreneurial, more subtle to find out more powerful investment solution. But I will come back later on that. But what will happen as well is an increasing overlay engagement process. We heard Compon Suisse yesterday on cement. BlackRock is starting to develop metrics for engagement. Hermes. The concern will be that you disconnect engagement on sustainability and investment decisions somehow. That's why metrics are so important to help these passive investing moving on the right direction. And then I believe that some thematic investment approach will develop, mainly in energy transition, climate change, biodiversity. I think that those institutions will progressively move towards thematic investing for the goals.
Can I ask you, Melchior, just to understand, because with this passive investing, so to what extent finance can really influence what organizations will be doing? Because passive investing is
Now, passive investing will move hand to hand with active engagement on the value chain. That will come. It's already existing. Sometimes it's an alibi, to be frank, because it's very cheap to buy an index fund and pay a few cents to an active overlay engager. But I think pressure will grow and investors will really become more focused on important value chain dilemmas. So I think that would be the move. Now, where I believe that type of big institutional asset manager will change a bit the game will be in the private equity sphere. It was interesting to hear you because they will ask GPs to better embed ESG issues, impact issues, being hands-on in driving the company. In the past and still now, some public companies are escaping to the pressure of the market on ESG precisely to become private and trying to hide themselves from the pressure of institutional investors. That will not continue. So in a nutshell, I think that's the difference with the private investors.
Thank you very much. Nathan, I know you have strong views about the role of finance and what you call equitable sharing. Can you tell us a little bit more about that?
Okay, so let me begin, maybe backstep a little bit. And so for economists, finance is not just a service industry, as it is for the practitioners, that's their business, obviously. For economists, finance, I mean, it means a lot of things, but I'll just state two that are related to the discussion we're having now. The first is that finance is the facilitator of investment, and investment is what generates economic growth, what generates development. And in that sense, economists have looked at finance, financial markets, both present, historical, and so forth, in this metric of development and growth. Obviously, there are all kinds of externalities that could not have been foreseen. I don't think there's any industrialist, or maybe there is one, but it's not the common, that likes to see CO2 go up in the air or something and enjoys it. I think that there's all these externalities that we have come now to understand that they're bad, but at the time have not been maybe perceived as so. But in general, finance has this role, a very important role in terms of moving humanity forward, and it has moved. I mean, after all, we're sitting here in Geneva. We went out of the cave, we're going off of the trees, across the oceans, and this was all, or most of it was done with finance, for better or for worse. So that's one role of finance, and that's why it's really a big thing in economics, and therefore, if we think about the future, then as in the past, finance would play a significant role. I mean, there's just no way around it, and that's the first thing. The second thing that we do in economics, which is related to finance, is also relating to the discussion we're having here and subsequently, is that finance is also an incentive. It's also a tool, not just in terms of promoting economic growth, etc., but it's a very powerful incentive. So any of us in economics who are dealing with what we call principal agent problems and contracting and whatever, know that these things are very important. So the financial system, or the tools used by the financial system, or the tools that could be used by financial system, are really powerful incentive mechanisms. So that's the link. So finance, if you want to move humanity forward in the direction we believe is the right direction, that will be done by finance. And the financial system or financial tools provide not all the incentives, we'll talk about regulation and so forth later on, but financial tools provide incentives. And so that's how these things are linked in some sense. And that's the role of economists in terms of understanding how to push this thing forward in terms of once you break it down into these elements. Okay, so so in this kind of framework, and again, for time considerations, we can talk about this for hours, but just give an example that we discussed in preparation for this panel is the role of equity or share. It's not by accident that we have these names. Kind of think about it. Why do we call it equity? Why do we call it share? And why do we call debt? And what does it mean? And so if you look at the Modigliani-Miller theorem, there's no difference between debt and equity, right? I mean, these are two different tools to finance, and you know how to do these things and get them to be exactly the same financially. But they mean different things. They mean different things. And meaning is really important, going back to what Bruno said about spirit of things. People attach meaning to things. And maybe for the people in the financial industry, those meanings, or Modigliani-Miller, these things are the same, but they're not the same. And when you go into debt, your behavior is different than when somebody has an equity share in what you're doing or is sharing in your success. It makes a big difference for people in the way they think about their purpose, they think about what they're going to do, the risks they're going to take, and what it means. And so giving sort of microfinance where people are in debt, these poor people are in debt. So think about it. I mean, every one of us, or most of us, have been in debt at some point in life. It's not a great feeling, right? But when somebody invests in you and provides you equity and shares with you, it's a different incentive. And so I think that the future moving forward, and again, it's combining these things, is that share, what we call sort of equitable sharing, is a way of investing that aligns more incentives together, going back to what Melchior said about passive investors. So pension fund holders, I mean, it's you and me, right? And most of us are forced, or at least in many countries, pensions are actually something which we have to do by law. It's something that provides us with a tax benefit. It's not just passive investing for. I mean, you can buy an ETF as an investor. I mean, that's a different thing. But the big money is in the pension funds, and that's money that's actually managed passively. But if we apply these principles of equitable sharing, we can actually move forward and use this great pool of money in the service of humanity. And I think nobody would object to this. Once we set it up correctly, once we design the incentives correctly, the purposes for these things, and since the government, and since a lot of it is sort of subsidized by governments, I think, and then we'll get back to the role of governments, there's a big room for maneuver there in terms of trying to move and align incentives in the right direction.
Thank you, Nathan. So if I use your expression for finance to move humanity forward, which I like, so what is really needed? And I'll start with you, Rosa. So I mean, to the extent that we have, an alignment with I would say the asset owners, how do we measure that impact? I guess there are still some gaps there. I'd like to hear your thoughts.
Yes, I mean, first of all, I love the equity versus debt And I think we'll come back to this, because it's not only the feeling, it's also the relationship that you have, with the counterparty. And we will talk about engagement, how companies engage, how the financial industry engage, and how you can engage both in the equity and in the debt part. And we believe that actually engaging with the debt is even more powerful because of the position that you have. So I think, it's an important distinction that we have there, as it is important to talk about passive. And there is a role that passive can have, because, passive means replicating an index. In general, part of the financial industry, and we are Big Day is part of that. We believe that exclusion is not the way forward. Is not by throwing your your garbage in the neighbor garden that you solve the issues of the world. We want to engage, but if there is a moment in which we decide that a part of the industry is not gonna transform to sustainable, is really something that we don't have hope anymore, then this is where the passive can come in. We have seen it, indices excluding controversial weapons. If indices exclude controversial weapons, the passive managers will exclude controversial weapons. And now that's the issue that we have, and Melchior was mentioning. Then who is going to buy those controversial weapons? Because if government then buys the controversial weapon industry, then we are not solving the problem. But going back to your question about what is needed there. Definitely there is a need for, collective action. And this collective action is, again, the role of government, international organization, together with finance. And that's why I think, that in Geneva we are very well placed, because we need to work in concert. Again, talking about this risk-return frontier, and thinking about all those activities, all those topics that we believe are very important, that have somehow a value for us, but not yet a price, because unfortunately we have this distance between what we value and what we price. So we need to work together with government and international organization to ensure that we realign our values with the price, so that we get to the risk-return frontier. In a lot of cases, and we can debate for hours about this topic, we talk about the three, risk, return, and impact. So how can we create, instead of this model, with two axes, a 3-axis model, risk, return, and impact? The question is, I think, that what we are going through as practitioner, instead of having a third axis, we are going to including impact into risk and including impact into returns. Somehow, because probably facilitates the calculation in some cases. So let's look at what we have done for climate. For climate, we have realized that there are physical risks and transition risks, and we are embedding this axe of the climate change issue into the risks. At the same time, we have realized that those companies that decarbonize first and are innovating in low carbon solutions will have better returns in the future. So we are incorporating in the return. So the question is, is every topic embedded? Can every topic be embedded in this risk return? Can we move those topics that are important for us, the 17 SDGs, into having the shape of the risk return frontier? And how do we do it? And probably it's the collaboration with government that is needed. And to do all of this, it's exactly the last question that you asked, is how do we measure impact? Because if we want to embed impact into the return or impact into the into risks, we need to measure it. And today we have tools to measure a lot of things. In a lot of topics, we have tools to measure SDG 13 for climate change. We have tools to measure when we talk about gender equality. There are still there's still some difficulty in measuring every of the topic that we would like to measure. And this is where we need to move forward. In some topics, the difficulty is really gathering the data. In some topics, it's choosing the data, because we have so many data that we don't know how to choose. And then you go back to the 600 ESG data providers and the very low correlation, because they simply have different perspective. But this is this is a place where we from finance as practitioner and the data providers and the enormous AI power that we are having in the world, we can work together.
Thank you. A lot of data, but not, as you said, always consistent. And I think we've made some progress on some specific topic like climate change, where I think we know a little bit better how to measure things. But in a lot of topics that are related to the SDGs, is still very unknown and still very unclear. What are the good practices that company should anchor? Melchior, do you want to tell us a little bit maybe around the impact investing? What are if we want, or at least if we want more impact in the investing space, what do you think is missing, and why what we call today impact investing is not scaling up, basically?
Okay, so I'm not sure impact investing is not scaling up, to be frank, but because we have to, maybe not fast enough, but if you have to distinguish private debt, private equity, impact investing solutions to liquid, so-called impact investing solution, which is more tricky concept. But if you look at the private debt, private equity sphere, let's assume for impact, which is illiquid, very often invested in frontier and emerging markets, so very risky. I believe that if that industry can take 1% of an asset allocation, it's already a good score. So if you look at the 100 trillions, you said, of capital markets, and it means that impact investing should occupy a space of 1 trillion. Which is huge, and not sure that there are enough investment solutions so far. If you look at microfinance, we need to be very careful not to pour too much money too fast in emerging and frontier markets in order to avoid over-indebtedness, liquidity crisis. We already experienced a few. So I think the momentum is there. If you look, the sale of Blue Orchard to Schroders is a sign that impact investing tends to mainstream. And Schroders really wants to transform Blue Orchard into a powerhouse of impact investing. That's a very good news. Other impact investing boutiques like Blue Orchard are looking at alliances with banks or big asset manager, and that will come. And now if you look once again at the listed impact investment solution, it's a little bit more tricky because you see a lot of so-called impact funds linked to the MSCI World Global Equities, for instance. So you diminish a little bit Nestle, you increase Unilever, and you have a more impactful portfolio. Is that right? So that's very tricky. And but it works so far, but it might be somehow suspected of greenwashing. What will require investors on those solutions will be additionality. You know, when you were investing in a microfinance fund, you put 1 million of your assets in a microfinance fund, you ensure access to at least 500 women to working capital. So you have an additional impact. But when you invest in a global equity, so-called impact SDG fund, what really is your additionality? So I think that a search of additionality will come. That will be an acid test for qualifying so-called impact investing liquid solutions. That could take the road of engaging for an additional impact. A lot of funds are moving that direction, but it's very tough, very difficult to showcase that in engaging you really produced an additional impact on the value chain, on governance, on processes and things like that. But that will be the prerequisite, I would say. And then the last development will be, I believe, more and more thematic funds on energy transitions, which will claim providing an additional impact. That will be, I think, the next trend.
Thank you, Melchior. Nathan, can we hear you about the role of regulation in finance? Do you think that self-regulation will be enough, if I may say so, or we will need actually some government rules?
So again, in theory, self-regulation could work, provided all the other components of what we think are competitive markets are actually in place. So it's full information, which is, I think, the serious thing. And even with an eye on data, we're seeing that information is really a big issue. So once there's no full information, then markets usually have all kinds of problems, as we call them, market failures. And so that's why these things don't tend to work on their own in the sense of information, but also there's the question of enforcement. And so once you don't believe that the perfect market, which is some ideal, works, then you need some enforcement. And the question is, who's doing the enforcement? Is the enforcement done by the people in the industry? Is it done by the market participants? Or is it done by a third party, which is usually the state or international organizations or people that don't have a direct stake in this transaction? And that's kind of, and so when I teach these things to my students, I start with a very simple example of a 100-meter dash. Okay, so what's more competitive and more simple than running 100 meters, right? I'm not talking about the banking industry and other financial markets. It's a very simple competition, running 100 meters. And anyone who watched the Olympics or any competition knows how much regulation is just to run 100 meters. Well, it's just from here to the end of this place. It's nothing. And why do we need all this regulation? I mean, we have purpose, right? People want to win, they get a medal. I mean, everything is aligned. I mean, it's pretty clear, right? It's not a very complex thing. It's a very simple one. And it doesn't work on its own. It doesn't work on its own. And so if we move forward to very complex industries with a lot of market failures and information asymmetries, so in theory, I mean, we would like it to work, but it won't. So obviously, we don't have to. I mean, people that are in the participants have to have responsibility, and we have to build those things and rely on them. But in the end, you need regulation, and I think that's an important factor. And we know that regulation can move the industry in various directions. So that's why I think these things, I mean, you can take an optimistic or pessimistic view about ESG and COP and all these things, but the fact that the regulators are starting to talk about these things. So again, not all regulators. Some regulators, like financial regulators, say, go back to the old metrics. We only care about maximizing the return for the investors. All the rest is not my problem. And some financial regulators already taking a stand and saying, it is my problem. That these things should have impact, that these things should be sustainable, and it is my responsibility as a regulator not just to. So regulation is not a magic word. It means that regulators also have to understand the kind of things we're talking about and what's their role, because they have a huge role. And the financial industry heavily regulated. We know it's heavily regulated. The banking industry, the pension funds. Everything is heavily regulated. So you have this regulation in place already, and the thing is to make sure that this regulation moves the needle in the right direction, and aligns the interests of society with those of the investors. And I'm sure that and these things work. And even with regulation, you have to have enforcement, which it's. So we're not in the world where, even with the regulation, that everything works. So we also need enforcement. Again, and so enforcement is usually, if it's not a very, what we like to say, intimate settings where everybody knows everybody, it's easier to enforce. When it's a small group of people, it's easier to enforce things amongst themselves. But if it's an anonymous market, if it's those 100 trillion and so many countries and so many assets and so many firms, it's really hard to enforce these things at a scale where people know each other and trust each other, and it just doesn't work. And so it works in a small club. So if you have the club of private bankers in Geneva, you can enforce things maybe in this environment. Because you know each other, you meet each other, and it's a small group with relatively high entry barriers to get into this, and so forth. But if you look at the financial system in general, what the big money is, and a lot of it is passive money, then obviously it's really hard to enforce this without some regulation.
Thank you. So given we're a bit late, can I ask you to conclude in 1 minute? I know it's hard, with how you see Geneva as, as the powerhouse in responsible and sustainable finance going forward. We'll have another debate on that.
Okay. Now 1 minute is a bit short, but maybe just one thing I strongly believe in. We have no future in the big passive investing sphere. That's more US business, I believe, or Frankfurt. But where I think we could move is in developing, alongside the SDG 17 partnership, a new type of investment banking for impact. I give you an example. Look at Nestle Coffee for Peace strategy. Nestle is developing a new brand called Nespresso, called Coffee for Peace, and they are trying to empower fragile context in accompanying farmers, including them back to their lands, and creating a high-value capsule of Nespresso Coffee for Peace. That type of initiative along the value chain, which are creating an obvious positive externalities, needs to be linked up with the development finance agenda. A lot of development agencies, the SDC might be a pioneer in that sense, but SIDA as well, KfW, are looking of partnering with the private sector and financing their positive externalities through innovative financing. Look at the ICRC impact bond on orthopedy. That's a very interesting exercise, linking up private investors and public donors. So I believe there will be a lot of solutions which will both answer to the need of private clients who would be happy to see, okay, I got my Nestle in my portfolio, but I know that Pictet contributed in engaging with Nestle to help them, providing more positive externalities on poverty and social inclusion and things like that. But that will be as well interesting for the big institutional asset manager in providing through their overlay engagement impactful solutions.
Thank you. Nathan, you 1 minute, Nathan.
1 minute. Okay, so like Bruno, I think I was drawn to Geneva. I mean, I lived elsewhere all my life, and what you call the Spirit of Geneva, and I think that at least where I'm at the Graduate Institute, I think that's also a focal point of this spirit, or at least reflects a lot of it in the Graduate Institute, and I think that's why Geneva has a role. And in particular, what we're trying to do at the Graduate Institute is take advantage of this unique position of Geneva that has both strong academics, strong financial industry, but also the presence of the international organizations that are setting the agenda of the things we're talking about, whether it's the SDG goals, UNDEP, whether it's the WTO, no matter what, a lot of it is set down here in Geneva. And so this interaction, and the Graduate Institute is the heart of it in terms of an international, very innovative, transdisciplinary institute that brings in a lot of students from all over the world, and with interaction with these institutions. What we're trying to do here at the Center for Finance and Development and through the programs is create, first of all, a master's program, a new master's program, Sustainable Finance, that will share this kind of things we're talking about in this room. We're also in the process of launching a lab for sustainable finance, which we hope that EOM will be a partner of, that will take advantage of this unique partnership. And the concept of the lab is unique partnership between academics, private sector, and international organizations, the IOs that are working here. So we have 2 partners already, the ICRC, talking about these kind of things, and the IFC. These are big players, and I think that's Geneva's comparative advantage? Because in New York, you have the UN, which is the political thing, but here are all the IOs that are actually doing the kind of stuff that we're interested in.
So in 2015, when the 17 Sustainable Development Goals were announced by the UN, there were some numbers thrown out. It's like 3.9 trillion to achieve, the SDGs, of which 1.4 are out there from government and philanthropy. 2.5 trillion is the private investor opportunity. And I think, that what Geneva can do is can support, that transition for private investors to go into that 2.5, exactly as Melchior was mentioning. Because to get there, we need new instruments. We need innovative finance. We need blended finance. And we are positioned here because it's quite a small town. We are all here, international organization and private banking. We can bridge the gap between philanthropy and impact investing. So there is a gray area. There is a support that we can get from blended finance for early stage. The big difficulty that we have in the impact investing space is not obviously in the public side. The public side is demonstrating the additionality. In PICTE, we are obviously engaging with companies, doing research in that space. But the gap that we have is more in the early stage of the impact investing in the emerging market. And in those phases, blended finance is extremely important, and Geneva is well positioned.
Thank you very much, to the three of you for your valuable insights. Thanks again.
Thank you.
And I'm sorry we won't have a break because we are running a bit late. And we've asked Gavin. Gavin is here. I see him. So let me maybe introduce you, Gavin. Gavin Long. I hope, we can see him on the screen. Great. So Gavin has been following EOM for 10 years. So when EOM was still actually part of Mars, he attended a presentation at Sciences Po in 2019 on new prosperities. He also attended our Oxford EOM executive education program last year, and we started working with Gavin. Gavin has 20 years of experience in corporate finance and transactions, and he also has a very strong experience in providing tech solutions. He co-founded the Acacia Group, which is a PE investor group backed by ultra high net worth US families. And Gavin is a partner of the Acacia Group and he's acted as CEO for 2 of the portfolio companies. Thank you so much, Gavin, for joining us. Yeah, it's so thanks for doing that, Gavin. It's actually, I hope you can hear us. I don't know if he can hear us. Looks like he doesn't. So maybe let me just maybe tell you a couple of things before Gavin hopefully can hear us. Can you hear us, Gavin? So maybe a couple of thoughts that I wanted to share. You let me know, Gavin, when you hear us. So maybe a couple of things while Gavin joins. So, you probably know very well the PE space. I mean, it's a $3 trillion industry. And there were 2 interesting articles that were actually published not so long ago. One around PE makes ESG promises, but their impact is often superficial. And basically what it was saying is that ESG, there's no strong empirical evidence that ESG leads to value creation in the PE space. An interesting one. The second one was Private Equity's Midlife Crisis by Harvard Business Review, which basically says that investment returns are falling in the PE industry and that the traditional tools for generating performance have become less effective. And now, basically, the PE industry should move to an ecosystem-based approach, if you want. And it looks like Gavin can hear us, so it's great. So, and I think it would be great, Gavin, thank you so much for joining. I've introduced you. It would be great to get your thoughts on what is your aspirations in terms of developing a purpose-driven approach in the PE space that would reconcile impact and returns. And how do you think about aligning all the stakeholders, from the LPs to the GPs to the business managers?
Thanks, Nadia, and good morning. It's often rare in the East Coast when I speak to my friends in Geneva that I can say good morning, and it's still good morning there, but it actually is this time. Thanks for the question, Nadia. I think the way we've thought about private equity investing from a bit of a different point of view, and thinking about it within the ESG context is, as you mentioned in the first part of your question, there's not only no correlation to ESG driving financial returns, there is probably better evidence at this point that a lot of the ESG driven initiatives are not really driving any kind of really material social impact. That's not to say that there are not good activities going on in the marketplace. But ultimately, those activities don't seem to not only correlate to financial returns, but they also don't correlate to impact either. We've discussed some opportunities where you actually see companies meeting the ESG metrics. However, what they're actually doing is within their own ecosystem. They're actually still using methods that are exploitive and are actually hurting constituents within their ecosystem. Along the lines of that Harvard Business Review article, we see the ecosystem as the new era of private equity investing. One of the ways that we're employing economics of mutuality in the investment cycle is well in advance of the deploying of the capital. And so what I mean by that is, when we're looking at industries and we're thinking through greater purpose-driven themes, we're actually doing some of the ecosystem work in advance of the deployment of capital. So we're taking a purpose-led, research-led initiative, doing some ecosystem work, laying out some of those potential purposes, using economics of mutuality as a framework for evaluating what we could do operationally. And in essence, what I believe is happening with the drive of economics of mutuality and a private equity is we're beginning to realign the way capital is deployed to the operations of the business, and actually using the operational improvements within the ecosystem to discover new areas of value creation. So back to the whole idea of the Harvard Business Review article of private equity's midlife crisis, we believe EOM provides an incredibly powerful lens to actually create a new area of value creation by exploring that ecosystem and using that ecosystem to not only drive purpose, but give visibility into new ways of driving financial returns.
Does anyone want to ask a question to Gavin? Because I know we have a few minutes left, and I just want to give this opportunity to whoever has a question. So yeah, Yvan? So maybe, Gavin, if I and tell me, Yvan, if I got the question right, but basically, Yvan Pictet, who was on the advisory board of Blackstone, says that there are maybe two strategies in the PE industry. So the one you described, Gavin, which is a new strategy, and there was I would say, the old strategy around turning around underperforming assets, if I may say so. Through cost savings and so on. So would you say that these two strategies are like two clear-cut strategies, or do you think, and the one you describe is the new way of basically doing PE?
Yeah, I do think I'll say that I grew up in the PE space more in the former approach, and Nadia, you please tell me if I'm going on too long here, but I'll just give a little history in that. My experience was largely I worked did some investment banking work with one of the top 10 private equity groups in the world, and its strategy was largely predicated upon what Yvan just laid out. And it struck me that did not seem to be, at least from my own personal ethic of what I was trying to get accomplished as an investor, it seemed really inconsistent. That's actually one of the things that led me on my journey to find Economics of Mutuality, and that was a long journey. By the way, I went through the process of evaluating some of Michael Porter's work in shared value economics, and some other social impact and ESG initiatives. The short answer is yes, Yvan. I believe this is the kind of a next generation and a new era of private equity that, listen, at some point, operational improvements we're going to require, a solid G&A base to make sure that the company is founded on stable financial operational principles. But I think we're leaving behind just this, kind of slash and burn private equity approach and entering into a new era that's driven by value creation in these respects.
Thank you so much, Gavin. And I just want to say that I mentioned this article, but actually, Gavin, you came up with that logic of creating value through an ecosystem approach actually way before that article came up a few months ago.
Yes.
Thank you,
Nadia,
so much. Yes, please.
I do want to, there's one thing that I would like to highlight before I leave is, especially with this audience, is I believe one of the things that's really imperative and one of the things that private equity really brings to bear is a longer term strategy, and the alignment of limited partners and the drive of limited partners to create real systemic change, I think is one of the most important elements of thinking through this. And I'll say it this way: by moving away just from simple IRR driven approaches toward private equity and moving more to MOIC, to money on invested capital, and taking longer term approaches, we're finding direct institutional investors and family offices that are willing to take a very patient approach. The wonderful thing about that is using the operational improvements that we can use within the ecosystem approach and the economics of mutuality approach does not make us sacrifice financial returns. It actually is driving financial returns. But what I will say is institutional patience or investor patience of taking a longer approach to really unfold some of those opportunities, I think is really critical to this next generation of private equity investing as well.
Thank you so much, Gavin. Thanks for waking up so early and joining us this morning. And thank you to all. I know we have to give the room back. So thanks for also letting us stay a little bit longer. And hope you enjoyed. As Lucy mentioned, we have our forum that starts today. So if you want to join us, you'll find all the information on EOM forum, Economics of Mutuality forum, Oxford forum. So hopefully you can join as well. And Gavin will also be one of the speakers. Thanks, Gavin.
Thank you.